Hello, everyone, and welcome back to another episode of WagMe TV. Episode 23 today, the Jordan episode. Shout out to MJ. We're super happy to be back here. As always, I'm joined by the absolute homies, the one and only, the All-American, Ev Smith,
How we doing?
the Doctor, Doc Mata,
What up, boys?
and of course, the NFT Lord himself, Alex Garcia.
Let's go. I feel like the way NFTs are going, we're gonna have to change that intro maybe, but I'm happy to be here for Jordan episode.
The big 2-3, the big 2-3. And we kind of just want to get into it, but before we do, we have a great episode planned today for you. Just a reminder for our fellow viewers, if you guys enjoy watching our content, make sure to like, comment, and subscribe down below. We love interacting with you guys. We love all the comments and all the feedback we get. So yeah, absolutely. Thank you guys so much, and let's get into it. Super fun episode planned today. We are going deep dive into one of the most important, one of the most successful, and one of the most interesting DeFi protocols out there. We're going to be talking about Uniswap today. And yeah, I'll throw it over to Armada, give us a little bit of a rundown and take us into it.
Yeah, definitely. I appreciate it. Excited for this one. We're going to kind of start pretty zoomed out and like the market fit for Uniswap, how it really works, go into a really, really simple example, and then dive a little bit deeper by the end of the episode. So if you know what Uniswap is, you're very familiar with it. Maybe you just want to skip towards the end when we get into V3. But if you're not super familiar, like some of us were, and myself specifically, might be helpful to stay around for the whole one. But I guess to just start out from a zoomed out perspective, the vast majority of crypto trading takes place on centralized exchanges, right? Think Coinbase or Binance, right? These are really governed by a single authority in that company that operates them, which requires users to place the funds under their control and use a traditional order book system, right? The biggest issue with this system is liquidity, which refers to the depth and number of orders that are on the order book. How liquidity means traders may not be able to fill their buys and sells, right? So enter something like Uniswap. So what is it? Just a broad definition. It's a decentralized or not owned by a single entity exchange built on the Ethereum blockchain that enables peer-to-peer market making via a trading model called automated liquidity protocol, right? So let me take a quick step back. That is kind of just overall how we would view Uniswap, but let's go into like a super simple example. So say you're a wheat farmer. You can create tons with your wheat. However, one day you decide you want some potatoes as well. We're flashing back way back in the day. So you head over to a potato farmer and make a trade with them, right? Wheat for potatoes. What you did is just traded the raw material. There's no taxes. We're not using a currency, etc. Right? Fast forward to more recently. So you're a wheat farmer. You have the wheat. You'd like potatoes. What we now go through is the process of trading in or selling that wheat for cold hard cash. And then we would head to, say, a local grocery store, and using that cash as a currency would purchase the potatoes, or really any other vegetable or fruit for that matter. So here again, we're using a currency, something to meet in the middle, and don't have to go direct to the source. We have essentially an intermediary, that grocery store. So we pay that grocery store a fee so that they can stay in business and have a reason to keep stock. And it is making our life a bit easier, I'd say. So as times go on, the supermarket wants to make a little bit more money. So they increase some of those fees. They know you're not going to travel the world to trade with the potato farmer, right? So bringing it back to Uniswap. Imagine wanting to find the original potato farmer to trade your wheat with. This is essentially within cryptocurrency what Uniswap is. So the Uniswap exchange lets you swap any Ethereum token for any other Ethereum token, and you pay a very, very small fee. So essentially, Uniswap is the grocery store here without cash. You give them wheat and they immediately provide you the potatoes in that example that I was utilizing. So how does it work? At least at its core, right? For V1 and V2, which we'll get into in a minute. It's really just a game of supply and demand. If you're the grocery store in this example, right, they keep a large bin in the back with a ton of wheat and a ton of potatoes, so anyone can make that trade. And if someone comes in and buys a ton of potatoes, so there aren't as many left, they begin charging more for those potatoes until someone restocks that supply. So for a more practical example within Uniswap, say the wheat is Ethereum and potatoes are another token, say like, what's a good ERC20 token, like Magic Internet Money, right?
Little meme.
One of my faves, one of my personal faves.
So wheat is ETH and Magic Internet Money is the potatoes. If Uniswap is the grocery store, you give them the ETH and they provide you a fair market price for the Magic Internet Money. And after this, Magic Internet Money likely increases in price and the price of ETH then drops. So in some cases, which we've talked about in the past, traders can buy Ethereum from Coinbase and actually make a profit by providing it as liquidity to Uniswap. And this essentially is an example of what an automated market maker is. And that's essentially what Uniswap is all about. So just to step back really briefly, where is all of it coming from? Again, the grocery store is Uniswap. What we actually call this in real life is a liquidity pool. So as more of one is traded up, the other is traded down. And they have what we call liquidity providers who provide liquid assets to the pool. And so this automated liquidity protocol solves the liquidity problem I mentioned with centralized exchanges, as buyers or sellers don't need to wait for an opposite party to appear to complete that trade. So then the question comes up, why be a liquidity provider, what we call LPs? So the investors or liquidity providers actually grab the fee that I was mentioning before via a token that they're provided. That rewards them to provide their asset to do quick swaps, and they also gain the fees when they elect to leave and destroy that token that they held. I'll stop there, kind of just to bring it back to earth, right? That was a lot, but I felt like it was a really good example that helped me to understand exactly how the automated market maker works, what Uniswap is doing in the space and what they're looking for. But any feedback on that or any thoughts on that so far?
When they came out with V1 in 2018, was it the first like official automated market maker that used AMM like for a wide, like for high volume in crypto trades, or was there one before that? You guys know?
I'm not positive, but I think they did have first mover advantage with V1.
Yeah.
Is that the case?
And so there's actually a really cool story behind this. So essentially, there's an Ethereum Reddit where back in the 2012 2014 days, a lot of people were just kind of throwing ideas out there, and I don't know if Vitalik was the original one that put together the idea for it. I think it was a combination of other ideas in the Ethereum Foundation of other people in there, but basically Vitalik put down the idea that this could conceptually happen. And so I don't know if Armada's going to go into it, but Hayden Adams, the founder of Uniswap, really smart guy, young, just one of those like bright minds in the Ethereum ecosystem, just kind of went about building this for a couple of years. So it was technically like a idea from Vitalik, and I think Hayden was one of the first to really put it together.
Interesting. Super interesting story. I like to show this visual, just to supplement kind of Armada's explanation of automated market makers and liquidity providing, because it helps to just kind of visualize what's going on a little bit. So if we see if it loads, if we look at this, right, what you have here is essentially the liquidity pool, right? And you have the liquidity providers here who are just people who have crypto in their wallets, right? And they're looking to generate some sort of yield on those assets instead of just letting them sit dormant in their wallets, right? And so what they do is they actually lend their assets into this pool, right? And that pool is being used within the decentralized exchange to do the swapping, as Armada was kind of mentioning. Now, here's your person entering the grocery store, if you will, right? And looking to, buy certain items or whatever. What they're doing is, instead of transacting in a order book fashion, as you do as in a centralized exchange, where you're getting basically crossed between buyers and sellers and get connected by that central entity. What you're doing is you're just interacting with the pool, right? So you're swapping within the pool, and it's all automated through code, and you're getting charged a fee. Now that fee is then used to reward the folks that are actually lending their crypto out for this all to work in the first place, right? And so I don't know. I like to show this little visual just to better kind of like conceptualize exactly what Armado was saying. I mean, everything he said was exactly right. So hopefully that just gives the viewers a little bit of more visual representation in terms of what's happening,
Oh, that's perfect. And so I think what we'll get into next is V1 and V2. You could almost, I don't know, based on some of Hayden's things that he said, it's almost like a beta-like version. But now there's V3. And Evan, did you want to get into that?
Yeah, I can. So yeah, great coverage of all the lead up Mata and kind of the background there. I think one important part of the V1 was just the idea that, like you're saying, like you could easily come in and create a website around. I can't share my screen. Can you guys let me share? Basically create a website around switching ERC20 tokens. And that was something that, like Garcia asked, hadn't been done before. And so this is actually the original V1 website of Uniswap. It's just something where you got a couple different pairs. There's not a lot here. I don't even think there's anything in here
No way.
around liquidity providing. Like this was basically his old GitHub that he had stashed away, Hayden's old GitHub. And he was like, people wanted to see it. And so he was like, I'll throw it on this website here. So this was actually the original V1 of Uniswap. And basically all this had was a user could come in, swap their Ethereum for another ERC20 token. And that was essentially all the transactions that would happen. And it's interesting because, this is V1, and in V2, you add another persona to the ecosystem. And I think maybe in later versions of V1, it was added in, but that liquidity provider, that person that's bringing in the cash or the currencies to be able to create these trades. And so it was one of there's a lot of market makers that do this. Sushi Swap was another this decentralized exchange that was actually forked off of Uniswap. And it creates, liquidity for different people. But the thing that sets Uniswap apart in this V3 that Mata alluded to is the ability to create basically liquidity ranges that you want to provide liquidity to in the pools. And this is something that hasn't really been seen before for V1, for V2, for other automated market makers in the Ethereum network. It was essentially that you would put $1,000 worth of Ethereum in a pool, and it would be spread evenly across all different price matches that could happen. So essentially, if I had a stable coin like USDC and I had Ethereum and I wanted to swap between the two, I would come in, and that liquidity provider, like we're talking about, would have money in the background to make this switch happen. Well, on that liquidity provider side, when they put their money down, it spread evenly across all possible transactions that could happen. So if Ethereum was $1,000 and USDC was $1, they would have a little portion of their money put there so they could collect fees. If Ethereum was $4,000 and USDC was $1, they would have a little portion of their money that they deposited there so they could collect fees. I think that's probably a lot of different numbers thrown at you, but the general gist is that they were only able to collect small amount of fees based on the total money that they put in the Uniswap decentralized exchange. Turn the page to V3, and now you get to pick where your capital can be used, where your cash can be used. So if you think Ethereum is always going to be around that $1,500 mark, and you want to provide liquidity to people that want to swap $1,500 worth of USDC for $1,500 worth of Ethereum, then you're able to do that. And the minute it goes outside of your range, you no longer provide liquidity. So this is kind of an intense idea. Yeah, do you guys got any questions about that?
What happens if it goes outside your range?
You're basically just not providing liquidity anymore. Your capital is not used to make transactions or swaps.
I see. So you're not actually earning fees then either.
Yeah, correct.
Correct.
So it seems. Go ahead.
I'm wondering if you still experience
impermanent loss.
Yeah, exactly. Are you still experiencing the impermanent loss that you would otherwise? Or is it like a safeguard?
I think it's somewhat of a safeguard. I think you can definitely still experience impermanent loss depending on the range that you choose. And so if you've got a wider range, you're going to be more susceptible to impermanent loss. Whereas if you have a tighter range, you're not. The problem is it's risk reward, right? If you have a super tight range and you have Ethereum bouncing above your range and then back below your range, you're not able to collect any fees.
Right.
You want the Ethereum price to stay within that range that you're providing liquidity for.
That's actually super interesting. I like that.
I feel like what it essentially allows, V3 kind of allows that expressiveness in the liquidity provision. That just makes it a little bit more efficient rather than providing it for either side, right? ETH is X to infinity, and then this other coin is, X market price to 0, right? They're allowing you to provide a range in there so that you can have unwasted capital, right? And so it's basically just kind of infinite malleability in generating those parameters around providing liquidity rather than that X times Y equals K that is typically utilized, so that you can put a little bit more expression into what you think the market's going to do, right? So depending on the outlook of some of the coins you're providing, that could actually change how you would want to provide that liquidity, if that makes sense.
Yeah, that makes total sense. And it also switches basically the power in the market. So essentially in V1 and V2, like you mentioned, Armada, it was this expression of X times Y equals K. Basically, you have a curve, kind of like in this fashion, and the swaps that you can make on that curve are always going to reside on that, very well-defined line. When you switch to V3, all of a sudden, the people that are staking their liquidity are determining where these swaps can be made. If nobody wants to provide liquidity in certain ranges of an Ethereum price, then that means that a swap can't happen there. And so no longer is it this curve. You're able to kind of, make changes to the ways that these swappings happen. And so you can find like different, price ranges would have more competitiveness compared to other price ranges. And that's where it gets into, kind of like the fees and the wars to be able to provide the best liquidity to up your fees as a liquidity provider. So did you have a question around that?
Yeah, just having a lot of interesting thoughts here, because I'd imagine, as you were kind of alluding to right there, the price impact here would be substantial, right? Because, or potentially substantial, I should say, because if as you were saying, like if the liquidity dries up in a certain price range and it starts back up again at like a way different price range, let's say like a huge jump, right? Just hypothetically, all of a sudden, like, you could get huge price volatility just because that entire, in order to make a swap in that pool, you basically have to jump at a huge amount of price liquidity that isn't there, right?
Right.
It makes sense though, because when you think about, a super illiquid product,
Right. A new
like some of
coin.
these things, like I'm just talking about even in traditional finance, right? This is exactly how, a lot of these things work too, though, right? You think of like a very, very illiquid product, like who knows where it's going to trade next, right? And because there are no quote unquote liquidity providers, there are no buyers or sellers in, huge price ranges. And sometimes things don't trade for months or years. You could have massive, massive price swings, right? Over, over maybe just a few transactions. If those
Right.
transactions are far apart, or if somebody's feels the need to buy or quote unquote provide liquidity at a certain price. So it's introducing like much more intricate dynamics of, I think, what we see in just kind of the normal finance world. I don't envision this being like that big of a deal. It'll be more big of a deal for liquidity providers that are looking to get fees, because then you have a whole nother kind of variable to figure out.
Yeah.
I don't anticipate it being like that big of a deal though for like super, super liquid pools. For example, like Ethereum USD is like, I feel like not like a great example, because like regardless of where the price movement is, you're gonna have like a lot of liquidity around there. I think
Yeah,
like what
but
I'm thinking of like random shit coins and like what's gonna happen with those now, like
Yeah.
that's gonna be pretty crazy. Like if you're
Yeah.
talking like a really small cap coin with like barely any liquidity, and now you give the liquidity providers the opportunity to say, oh, like I'm gonna cap my impermanent loss, then like who the hell knows what's gonna happen? I don't know what's gonna happen.
Yeah, I think that's a bear case. Like, I think you can definitely say that like this is gonna, create price gaps in like different markets, and there's gonna be problems there. I think the other side that you would hear from the Ethereum Foundation and just bulls in the space is that there's inefficient capital in these markets. Basically, when you look at a stable coin swap, if you look at USDC, to DAI, you're never going to see a price fluctuation above like $1.01 or below 99 cents. But you'll see people wanting to make markets in these decentralized exchanges at like $1.05 or 97 cents. And what happens is in V1 and V2, in Uniswap V1 and V2, you were able to achieve like or create fees as a liquidity provider, even if you were in some ridiculous range. Like if you were in $1.05 range for stable coins, you still got some fees that happen for regular swaps around the dollar range. Compared to V3, you're now, I think you could set the entire range, but you're prioritizing liquidity providers that are putting their liquidity in very realistic ranges. And so you're finding people in this liquidity provider persona portion of the network that want to be more active, that want to come in and make a market right away. And so it's almost a way to, it is a way to create better liquidity in the market, because it's making those ranges and those markets more competitive. And so I think that's kind of the other side of that is, yeah, you could see where there might be price gaps like you talked about, but the bull case is, people are creating smaller and smaller ranges to be active in, and it's creating even more competitiveness around like creating better swaps.
So
let me know if I'm tracking with you here from like a capital. It sounds like more like a capital efficiency perspective.
Right.
So with V2, right? With Uniswap V2, you had to have essentially equal amounts of each token, right? And then the smart contracts, it sounds like from this perspective, they had massive amounts of what we'd call wasted capital, right? Like I was mentioning, ETH would be sold from market price to zero in those smart contracts, as well as market price to infinity, right? On the other side.
Inefficient capital, I think.
Right. So those prices might never be reached. And so you're providing liquidity on areas that to an extent don't necessarily make sense. And so by being able to provide that range, some of that capital could be removed and put in, or you can put in less to create that same exposure and place that capital in other areas, or put in the same amount and have a much larger effect or impact with some of those fees. Is that kind of what I'm picking up from that? You'd essentially gain more from those fees by providing a specific range that you're providing liquidity in.
And less capital is required for it to basically provide the liquidity within the range. And like the example ranges that I've seen have been, like, to your point, Saul, about getting like maybe too tight in some of these smaller cap coins. Like a lot of the example, I don't know if all LPs do this, but a lot of the examples I've seen have been like a 20 to 30% window. So like you're talking about, like, if ETH is at like 1700, like the window might be between like 1550 and like 1900. Now, like within the next, like, 20 minutes or hour or day, like ETH isn't going to move to one of those prices. So it's like, it seems like the windows, at least like the examples I've seen, have been like between 20, 30%. Obviously you can change that. But like the other thing too is I think looking at Uniswap and like the actual breakdown of, the different pairs that are being traded. Like if we're talking about where the demand is, it's almost entirely USD to wrapped ETH. So, you're talking 61% of 1.4 billion in volume traded on a single day is going just to this one pairing. So I think a lot of the concern about the lower cap coins, like it's definitely like it definitely demands merit, but at the same time, I'm sure Uniswap's probably looking at like, let's say the top 7 that have above a point of volume percentage in terms of what they're actually doing on Uniswap. But that's kind of my next question, was like, can they selectively apply the V3 upgrade to different pairs, or do they have to apply it basically across the entire Uniswap platform? Because like I think Solon brings up a great point. Like if I'm trading a crappy like Rogan Inu, like, if I'm trying to trade that on Uniswap, like you're probably, for lack of a better word, you're probably fucked. So it's like, maybe they have a way to like have V3 for obviously like the top volume traded pairs, and then like V2 for maybe some of the smaller ones. But I don't know if they've talked about that at all.
Yeah, I don't know about that specifically. I think one update that they did make in V3 could be the 3 different pricing tiers that they have. So basically they've got the original, which is the 0.3% fee, the 0.05% fee, and then the 1% fee. And so essentially the smallest fee, 0.05%, would be used for stable coins like you're showing here. See, that 0.3 is, I would say, for probably 95%, 99% of just regularly traded coins, and then that 1% is for exotic, or very rarely traded coins. So I could see where that 1% could play a role, where maybe that's going to incentivize people to come into those markets, like you're saying, that maybe wouldn't because of how illiquid or uncertain they are. So yeah, I mean, maybe that could be the reason, or that could be a helping hand to bring people into those markets, but I don't know if that would directly impact that, to be honest.
And it sounds like something that could be noted is that they could set up their ranges so as to make it just that typical X times Y equals K, right? If they just set up the ranges in that same fashion rather than trying to pick specific ranges that they're working within, which I assume they're going to do with some of the more popular swaps. I think that that's maybe the direction that they would go, but I might be wrong on that.
I think that would probably work well. It worked well for V2 and V1. That's the model that they had. So, I think V3's been out for around 6 months now, maybe a little more than that. I'd be interested. I don't think I dived into any reviews of how the update has gone, and it's, probably mixed reviews. I think it definitely benefits LPs that want to come in and be more active. There's this tactic that people call just-in-time liquidity providing, where basically you race into the market, check a mempool. And so this is actually a tactic that can only be used on blockchains that have public mempools. Not all blockchains have public mempools. And so basically what people do is they come in, they check a mempool, they see what transactions are going to be happening in the next block, and then they race to provide the exact liquidity for that block. That's something where, it does not benefit the passive LP, the person that just wants to come put their liquidity into Uniswap and just let it sit there and accrue fees, or accrue the money they get from fees. So I think that's probably something that they need to, I don't know if they would need to address it, but they want to make sure they're not losing those people in the ecosystem. Those are the LPs, those passive LPs have grown Uniswap to what it is today. So I don't think that's something they would want to leave out of the equation.
I had a question. You mentioned something earlier, like in the previous version, I guess you were able to, like, there were people who were providing, when you were talking about like inefficiently used capital, right? Like, there's, I guess, people who originally were providing liquidity in like way out of bounds like circumstances. How does that like work though? Because previously you couldn't choose where you provided the
Right.
liquidity. So like, what do you mean by that?
I think that's a good catch. I think so. What I meant by that was that is something that could happen in V3. I think I said that it happened in V2 and V1, but in the new model it could happen in V3. And so the idea behind that is, you're having people in V2 basically gain standard like fees because it's distributed evenly
Right.
across all people that provide liquidity. Whereas in V3, you're able to pick that range that you want to be in. And I think the
or
capital
multiple ranges,
or
right?
multiple ranges. Yeah, you're right about that. But I think the capital efficiency comes in, finding those tight zones where you can provide liquidity. So that's a good catch, Shalom.
Gotcha. Okay, that makes sense. That makes sense. So you're basically saying that there had V3 been an option back then, there would be people who would be providing capital in inefficient circumstances. And so that basically takes them out of the game. It incentivizes people to provide liquidity around where the market is actually trading at. And inherently, since it's not so spread out, this similar amount of liquidity would be more focused in a more realistic range.
Right. And I think that's something where that's a big
That makes
discussion
sense.
around just-in-time liquidity providing, is that people are coming in with very realistic ranges at the last second, almost kind of like high-speed trading.
Mm-hmm.
And it's, hurting the fees that the passive LPs are accruing by just putting their money in and letting it sit, but you're creating better liquidity within that market.
Yeah.
So yeah, I think it's kind of like a two-sided coin, and something that is probably going to be talked about for a while, and we'll see how it pans out.
Yeah. What I'm hearing is basically this is a strategy to tighten the spread, right?
Exactly.
When you think about traditional finance and traditional trading, like all market makers have a spread, and that spread is basically the difference between what they're buying at and the difference between what they're selling that same asset at, right? And there's always going to be a spread, even if you look at stocks, or anything. There's always going to be a spread, and so this seems like a mechanism to basically tighten that spread. And what the MEV people are doing, the just-in-time liquidity providers, are coming in and basically creating a more efficient market. And so, yeah, maybe some of those opportunities for those guys will be shut down a little bit. But at the same time, yeah, no, it's super interesting. And it's good to see that they're focusing on that, right? Because this helps the end user tremendously, right? The end user who's just looking to swap their tokens, just to be clear, this helps them a lot, right? If anything to do with reducing the spread on the transactions will definitely help the end user a lot. So,
and that'll reduce the slippage quite heavily, right? Like on just some of those like altcoin transactions. Like I know when I've swapped alts that are on Ethereum, like the slippage tends to be pretty bad. Like I'm sure that range window is supposed to tighten that up and like make sure that that percentage doesn't get too high.
Yeah, absolutely. That's something that they definitely focused on. And I think you're right. Like there's different areas where, you know, it's tough to say that one system is going to work well for everything. Hopefully that addresses that issue, and then there's probably going to be other issues that come up in some of the larger markets that they have. So I think it's something to keep an eye on, and you know, probably something we could revisit and see how the entire Ethereum network is reacting to the new V3 changes, and yeah, to see how it's going.
Yeah, that's interesting. I might try to play around with this a little bit. I mean, you guys know, like I've done decent amount of liquidity providing over the last year or so or whatever, and so I might try to go mess around and see kind of what the user. I'm curious what the user interface is and stuff on like how you set the ranges and like kind of like backstop mechanisms that you can have potentially and things like that. So yeah, we'll be back with a review maybe Uniswap V3 and from a liquidity providing perspective, that'd be kind of cool.
And I wasn't able to, like, when we were researching for this episode, I wasn't really able to find like a good like V4 like 2023 like roadmap. Like, do you guys know what, like, obviously they just launched it 6 months ago, but do you know what's kind of like next up for Hayden and like the rest of that team? Like, do they know where they want to take it next and like what V3 was going to set them up for?
No, I don't know it specifically. I know basically when they launched V1, they always had this V3 model in mind. So V2 came, they added oracles, and I think they added a couple other different features, but they always knew that they wanted to get to V3. And so it sounds like it's from you know, the gist that I gained of watching interviews of Hayden talking about this newest release. They want to get the feel of how this is impacting the community for the next, you know, year or two, and make small adjustments off of that. I'm sure they'll be able to add in more pairs and you know, create better partnerships. But yeah, I don't know if they've announced a V4. That's something we could kind of get back to the listeners with if we do find it.
Sweet.
Yeah.
That was super interesting.
Cool,
Yeah.
cool. Well, thanks so much for definitely Armada and Ev. You know, you guys did a lot of the research on that one. So thanks for taking us through that. Super useful, very interesting. We'll definitely you know, keep a pulse on it and keep updates coming out as things kind of progress. Today we kind of flipped around our episode a little bit, went straight into the topic. And so kind of now our chance to open it up and discuss a little about what's going on in the markets. What are we looking at? Yeah, how are you guys feeling about what's going on? I mean, a couple of big news pieces out this week. What are you guys looking at?
I think there were two really big ones, at least today, that came across the desk. The first was this Nomad crypto bridge hack, right? That was a big piece of news this morning. You thought, okay, that's the bad news for the day. And then MicroStrategy CEO Michael Saylor stepped down as the CEO. He's now going to be a chairman, and he said he's going to be specifically focused around Bitcoin. This is all still pretty fresh, right? I'm not really quite sure how to interpret that. I feel like bridges, to go back to the first piece, there's just kind of been issues with bridges as a whole, and it's something that's going to be necessary, the interoperability between some of these blockchains moving forward. So, you know, some could say fail early and then you'll succeed, right? So, you know, hopefully they can start to figure out some of these bridge hacks and why they're happening, and you know, be successful later on. But you never like to see, you know, some organization or people losing tons and tons of money. So not the greatest news that came out today, but I don't think we saw too big of an impact on Bitcoin's price. So who knows what's going on in the market.
Yeah, the bridging stuff we'll get into Saylor in a sec, but the bridging stuff is tricky because we've just seen so many, right? Like, just it's like hack after hack. And Vitalik actually has like a famous, I think he was either on a forum or an article or something where he points out that like it has inherent vulnerabilities, and that's due to the fact that I think we discussed this maybe on a previous episode, but when you bridge a token from one blockchain to another, the bridge is the intermediary, and when you bridge your token across, you're not actually using the same token as you were before, right? What they're doing is they're holding the tokens that you bridged in an account, and they're giving you another token, which you then go and you use on that specific blockchain to do whatever you want to do, right? And when you come back, you get your tokens back, and you come back, right? And because there's just basically the more the bridge gets used, there's more and more value basically accruing within this bridge. Makes it like a huge target for vulnerabilities, for hackers to go in and try to find those vulnerabilities, and if they're able to, get out with a massive sum of money, which we've seen time and time again. So definitely something that we're gonna have to figure out, and we'll kind of see how that goes, but you hate to see it. And then I don't know if ever, Garcia, you have any thoughts on that. Otherwise we'll just run straight to Saylor.
Yeah, no, I thought I saw a couple different screenshots on Twitter. Essentially the hack was like around decimal placement, where it was like you sent 0.1 Ethereum to the bridge, and then I forget what the other side of the bridge was. You got 100 of it back, and it was basically just repeated attacks, basically slowly draining the bridge, which I feel like that's something we've seen in DAOs before, where it's basically an attack just slowly draining like different pools of cash that are there. So yeah, definitely tough to see, but I'd be interested to hear more about how that was done.
Yeah, I just think this is like one of those things that institutional investors and larger Fortune 500 companies that actually use technology like this is kind of the stuff that they are kind of waiting to be cleared up, because the value of a bridge is like incredible. Like you're basically, from like a corporate Web2 standpoint, you're basically shifting payment processors instantly with no middlemen, which is like really difficult to do as like a large organization in general. So I just think bridges are super important, and to have like reliable ones like obviously is going to be important in terms of getting more crypto adoption. So the sketchiness of the current bridges definitely needs to be corrected if that's going to happen.
Totally agree. Yeah, so I guess we'll just hope that the bridges can get it figured out. Like, I guess that's the only thing we can really do, or we can hope for the hackers to quit, but that's definitely not going to happen. So what do you guys think about Saylor? It seems like all the big men this year in crypto just going down one by one. We had Danny, we had Do Kwon, we had Zoo from Three Arrows. We had now Saylor. Seems like everyone's kind of biting the dust here.
Tough to see. You hate to see it.
I can't really tell, because it feels like, I think the way that they put it is like, splitting the roles up. Chairman versus CEO allows them to kind of better pursue the two separate corporate strategies that they've kind of taken on, right? One being the analytics software, the business itself, and then the other just being acquiring and holding Bitcoin, right? So I feel like they have two different strategies, and it sounds like at least Saylor is going to be focused obviously on the more Bitcoin side of things, and their current president, if I'm correct, the MicroStrategy is going to be now the CEO, who's going to be focused obviously more on the SaaS part. So again, like, I don't know how much of an impact it necessarily has. I don't actually know. Did it have a big impact on MicroStrategy's price today after hours when they were announcing all this stuff? Or
no, it's basically stable. It's like 0.91% up in the last 24 hours. And I think I'm kind of curious. I actually typed it in to see if I could find it really quick, but I'm like my kind of hypothesis is that so MicroStrategy is not a young company. Like they were founded in '89 and he's been the CEO since then. And so my kind of like working hypothesis is that the main investors in MicroStrategy were probably starting to get concerned at how much of the focus was turning to Bitcoin, where it's like, listen, like we're invested because we enjoy what you guys are selling as a software. And now the CEO is basically making it a Bitcoin fund. And so I'm wondering if the pressure came from like a lot of the more high impact, really involved investors kind of saying, well, what's the direction of the company here? Are we a Bitcoin fund or are we like a business intelligence software? So, it kind of sounds like he's going to be kind of reallocated out of CEO to do his own kind of Bitcoin thing not on the side, but in a different role of the company. So I think it's definitely shocking, but I think it's maybe a little less bearish than I initially thought as I started to do a little bit more research, but that's kind of my working thought right now.
Was there a official number that came out of like what their losses were on Bitcoin?
It's upwards of 2 billion. Like if he were to sell it, right? I mean, like,
Right,
I don't
if he
think
were
he
to
plans
sell
on
it.
selling it anytime soon, but like they need to show, and I guess actually it's probably a better question for Soham. Do they show that like, so like investments, they show that as like a net revenue loss if it's not?
It's not a revenue loss. It's called a I was actually just looking up before this, impairment charge.
Impairment charge.
Yeah, and it's basically a drastic reduction or loss in recoverable value of an asset, right? And so the loss that they took in this quarter was 917.8 million in the second quarter. And that's up from 171 million loss in the first quarter. So basically quarter over quarter, their impairment loss that they like realize, they didn't realize it obviously because they haven't sold it, but that was on their books was 917 million, which is obviously quite a lot.
It's also quite a lot when your revenue is 500 million a year, and so it's basically like 40% of your revenue is what was lost in that one quarter. So that's gonna be tough to come back from. And
The
I think
dude
it's
was just
definitely
aping. He was just aping like the
yeah,
rest of us.
it's a warranted move to maybe move him out of the CEO spot and into something a little less important on that front. But
When I pulled up like just his like most recent like Q2 earnings presentation in May, and it's like it's such a Bitcoin heavy presentation. Like it's basically like talking about total addressable market, talking about it as an asset class, and like how MicroStrategy is positioned. So like I just wonder like how long the investors were willing to put up with this. And so they're like, all right, dude, like where's the company that we invested in? Like, well, what's going
because
on
they
here?
sell analytics and like
It's
business
like a
process
Tableau, like
automation.
yeah, it's like a Tableau kind of competitor software.
Right.
So it's like Bitcoin, like where does that come in here? So it's
Yeah, it's
interesting.
just a big Bitcoin proxy at this point.
I mean, it's funny because if you look at their stock chart, didn't do anything until they started getting into Bitcoin. So the investors can't be that pissed, right? Like,
True.
like they were chilling at like kind of the same stock price for like 5 years. And then lo and behold, 2020 comes around and they just 10x.
It is just so surprising to see that this company was started in 1989, and
Yeah.
this is the pivot they do after 33 years of analytics. It's it almost seems I don't know, but it almost seems a little bit like a midlife crisis. You get in there and you go, hey, we're switching this entire 3,000 person company to Bitcoin.
Well, yeah, I and it's also like Michael Saylor is kind of like that. I don't know, like he's amongst the crypto community. He's seen very much as like a finance guy and not really knowing the technology very well. I don't know if that's true or not, but like Charles Hoskinson has called him out a ton of times, and like because he's Michael Saylor shit on like ADA and like other cryptocurrencies. He's like, oh, they have no value. And Charles is like, you're just speculating, basically. Like it's just a risk on speculatory asset. Like you're not doing anything more than like we're providing utility. And so like Charles's point was like, dude, at this point, Michael is so into Bitcoin that like he actually like can't have it fail. Like he literally cannot have it fail.
Company.
So like, yeah. So he's like, I would take everything he says with a grain of salt. Like I'm not saying he's dumb, but I'm just saying like, listen, this dude literally his life depends on. Otherwise, he's bankrupt. So I don't know. It's just funny to see other like pretty reputable, smart people like talking about how you know, he is smart, but he could be a little jaded based on his position he's taken.
And to be honest, like there's worse acquisitions out there. You know, there's plenty of company acquisitions that don't work out. So I don't know if it's, you know, the worst thing that you still have, you know, what $700 million worth of Bitcoin or something like that left. Yeah, pretty crazy.
I respect the move. I feel like if you're, you know, if you really do, let's put it this way, if you believe that fiat currency is not the future, Bitcoin is the most well-positioned asset to take over in terms of like once actually all the supply is out there. Obviously now, you know, leading up to like 2028 or 2030 when the last Bitcoin is mined, that's going to be I mean, in terms of like technology, it's the leading case for a non-fiat currency, but
Man's got conviction. We can say that.
That is a fact.
Hundo P.
Gotta love it. Gotta love it. All right. Well, I think that wraps it up for this week. Jordan episode number 23 in the books. As mentioned before, if you guys found any of this useful, make sure to like, comment, and subscribe down below. And as always, we'll be back same time, same place next week. Signing off. Wag me.
Later, boys.
Wag me later.
Wag me.